Hey everyone, and welcome back to Everything Tesla Stock. Did you know that a veteran investor claimed that Tesla's current price is a once-in-a-generation opportunity to buy? The fact that so many well-known people have said it may make it sound cliché. It might even seem like a marketing trick to get people to purchase Tesla shares. To learn what Barron has to say about all this, you better pay attention and keep watching. The largest investment firms have divided between supporters and critics of Tesla, known as the leading EV manufacturer. Ron Barron, a well-known investor and evangelist for Tesla, are also well-known today. You're going to see in today's video why Ron Barron claimed that buying Tesla shares at this price is a once-in-a-lifetime chance. May saw the highest annualized inflation rate for more than 40 years, 8.6%. The result was a 75 basis point increase in the Federal Reserve's benchmark interest rate, the biggest increase since 1994. The stock market experienced its worst single week since the start of the COVID crisis due to high inflation and aggressive central bank tightening. Economists are now gloomily predicting a repeat of the late 70s and 80s, when similar inflation and high interest rates caused market weakness and a severe recession. According to experts, the prospect of inflation and a worldwide recession is as follows. Long-term investors, though, may not find this situation to be as dire. Price reductions due to the general market downturn may present opportunities to purchase premium brands in struggling industries. Ron Barron, a billionaire investor who's best known for giving alpha through his Twitter account, sees the current market as a once-in-a-generation purchasing opportunity. As stocks enter a bear market, Barron claims it's a once-in-a-generation purchasing opportunity. And it's also a really good chance to get in on all of this. This once-in-a-lifetime buying opportunity, the founder and CEO of Barron Capital noted, was in an email to CNBC. The S&P 500 has dropped to its lowest level since late 2020, according to Ron Barron. Still, this current sell-off in key with US equities indices really presents a great buying opportunity. When considering the economy in the long run, he claimed that the recent US market drop could offer Americans a great opportunity. When he launched Barron Capital in 1982, Barron compared the current state of affairs to early in his professional career. He pointed out that the early 80s was another period when markets plummeted as a result of an aggressive Federal Reserve seeking to contain inflation. He mentioned that his two investing sons now have an equal opportunity. He did so in 1982, the year the Dow Jones Industrial Average reached 880 during a bear market when he formed Barron Capital, an investment management company with headquarters in New York City, and a reputation for long-term investment methods. Wall Street refers to a stock market decline of at least 20% over a prolonged period of time, known as a bear market, which often denotes a downturn in the economy. The most recent bear market began on February 19, 2020, and concluded on March 23rd, a bit over a month later. According to a financial content site, Seeking Alpha, this bear market had the shortest duration of 33 days, and was mostly due to the effects of COVID-19. As the stock market later recovered, later on that year, and it remained robust until 2021, it was the worst economic crisis the country had ever faced. The FED investor made the case that the current economy is supported by a strong tech foundation that has been developed over the previous few decades, pointing the way to enormous upside potential over a lengthy time horizon. If you haven't already, let us know if you would buy Tesla stock down below in the comments section. Tesla and other brands were mentioned by Barron as examples of these kinds of businesses that might inspire the subsequent wave of technological innovation. Following yet another violent sell-off on Wall Street, the fund manager made his remarks. Investors' concerns that the FED's rate hiking program would eventually lead to a recession led to a more than 3% decline in the S&P 500 on Thursday, and a more than 4% decline in the Nasdaq. The S&P 500 has now dropped more than 23 points in 2022, and for the first time since December 2020, it ended below $3,700. Barron has a long-term bullish outlook, but lately there has been an increased anxiety about a potential short-term recession. Overall, though, we're still hopeful, and don't usually think too much about short-term problems like inflation, oil prices, interest rates, and the conflict between Russia and Ukraine. Inflation is always an issue, but few people have ever talked about it in my lifetime. The typical annual rate of inflation is between 4 and 5%, which translates roughly to doubling every 14 to 15 years. According to Barron, the stock market doubles every 10 to 12 years, or about 7 to 8%. Notably, Barron's prediction, which largely mirrors the recommendations, focuses on long-term investing as opposed to day trading. The investor also mentioned the economic benefits of watching compound interest accumulate. The challenge from investors now is to pick stocks that are poised to rise. Going forward, even if they are now, Sylvia Jablonski, Chief Investment Officer for Defiance EFTs, shares Barron's sentiments. She expressed her optimism after learning that inflation had reached a 40-year high. This is a fantastic opportunity for future generations. When you look back on it, this will all be noise. Squawk Box continues to warn that the coming months are going to be very unpleasant for investors, who are going to be likely to endure range-bound volatility in the short term. It's horrible, and if we just have to get through it, she said, well, then things should be okay. Some may be curious as to how people make money in the stock market. For more than a century, stock markets have generated wealthy investors. A $10,000 investment in the stock market 50 years ago could have resulted in a portfolio worth hundreds of thousands, if not millions of dollars. Between 1957 and 1921, stocks returned 10.5% on average per year, though capital appreciation may vary substantially depending on the company. This 10.5% annual growth rate is known as CAGE, or Compounds Annual Growth Rate. And while investing in the stock market has been one of the most effective methods to increase wealth over time, there are other options. In general, there are two tactics that investors can employ to generate money in the market. The first strategy is to buy and hold, and historically this one has resulted in the exponential expansion of investment capital. This technique allows investors to profit in two ways: capital appreciation and dividends. The difference between the market price of a given stock or mutual fund and the cost of acquisition is referred to as capital appreciation. Capital appreciation is not taxed until the deal is realized, at which point it is referred to as capital gain. Dividends, on the other hand, are an important means for shareholders to be compensated for purchasing and holding stocks. Dividends are periodic cash payments made by corporations to shareholders when they make a profit. In addition to the buy and hold approach, it distributes a portion of its profits to shareholders as dividends, while the remainder is maintained by the company as retained earnings. Investors can profit by trading equities with leverage, and other instruments such as futures can actually be used to improve the returns on their bets significantly. When investors employ leverage, they are effectively borrowing money in order to improve the returns of their invested capital. Futures are contracts to buy or sell a known amount of underlying stock at a later date for a predetermined price. Options are a great alternative to futures because they give the contract holder the right to buy, but not obligation to buy or sell the underlying share, whereas futures require both parties to buy and sell the stock. However, investing is a risk in and of itself. You should devote adequate time and effort to researching the stocks you are interested in. Short selling is a common investing practice used by hedge funds and traders to sell shares that the seller does not own. Investors who short a stock believe that the price will fall in the future. Therefore, they sell the stock now by borrowing it from brokers in order to purchase it back at a lower price later. If the stock price declines in the future, an investor will profit by pocketing the difference between the price at which the stock was sold and the price at which it was purchased. Tesla, too, contains both risks and opportunities for additional Tesla stock content. While you're here, go ahead and click on one of these two videos on your screen. See you there.